In episode 01, we learned that money is belief. In episode 02, we watched governments take control of that belief and slowly lose control of stability. In episode 03, we saw the system crack. We saw who really controls money and why that question changed everything. Now we arrive at the response. The thing that could only exist because trust broke. Bitcoin. Bitcoin did not begin as innovation. Bitcoin did not begin as a startup. It did not begin as a business model. It did not begin as a financial product. It did not begin as a way to get rich. It began as a question. A quiet, dangerous question posted to an obscure internet mailing list in 2008. Right as the financial system was melting down. What if money did not have to be someone else's debt? This question alone separates Bitcoin from everything that came before it. Every other form of money in your life, dollars, euros, bank balances, credit cards, all of it is someone else's promise. Bitcoin is different. And understanding that difference changes everything. The hidden truth of modern money. Let me tell you something most people never learn. In modern economies, almost all money is debt. When a bank creates money, which we learned in episode 03 is how 90% of money enters existence, it does so by creating a loan. Every new unit of currency enters the system as an obligation. Someone must repay it. With interest. This means money is born incomplete. It arrives with a companion, debt. And debt demands growth. The system must expand or collapse. Growth is not optional in a debt-based monetary system. It is required just to service what already exists. This is why modern economies fear stagnation more than anything else. Without growth, debt suffocates the system. Banks as the core of monetary power. Banks are not merely intermediaries connecting savers and borrowers. That's what textbooks say. It's what your economics professor probably taught you. It's wrong. Banks are monetary creators. They decide who receives money first, which sectors expand, which assets inflate. This is not political favoritism, usually. It is credit logic. Banks lend where collateral already exists. If you already own assets, you get access to new money. If you don't, you wait and hope it trickles down. Assets attract money. Money inflates assets. This feedback loop concentrates wealth structurally. Again, not by intention. By design. Debt as invisible governance. Here's something we don't talk about enough. Debt governs behavior. Governments shape policy around bond markets, because if they lose confidence, borrowing costs spike. Households shape life choices around mortgages, because debt must be serviced every month. Corporations shape strategy around leverage, because returns must exceed interest. Debt disciplines. But it also controls. Those closest to money creation experience flexibility. They can borrow cheaply, invest early, ride the wave. Those furthest from it experience constraint. They work harder, pay more, arrive late. This asymmetry defines modern power. Not ideology. Structure. Why Bitcoin rejected debt entirely. Now we understand why Bitcoin's question was so radical. Bitcoin makes a choice that seems simple but changes everything. It is not debt. No one owes you Bitcoin. No institution promises to redeem it for anything. No authority guarantees its value. Bitcoin exists without liability. It is not someone else's promise. It is not a claim on future production. It is not an IOU. It is final settlement. This is unprecedented in modern finance. For the first time in centuries, a monetary asset exists without counterparty risk. You either hold it, or you don't. There is no intermediary in between. No bank can fail and take your Bitcoin with it. No government can print more and dilute your share. This is what the Bitcoin white paper meant by peer-to-peer electronic cash. Not faster payments. Not cheaper transactions. But removing the counterparty entirely. Why this idea was so dangerous? If money is no longer debt, then banks lose their monopoly on creation. If money does not require credit, then growth is no longer mandatory for survival. If money cannot be expanded at will, then power becomes constrained again. Think about that. For the first time since 1971, since governments cut money loose from gold, someone proposed a money that governments could not control. Not because it was hidden. Not because it was illegal. But because it was designed that way. Bitcoin is not dangerous because of volatility. Stocks are volatile. Real estate is volatile. Everything is volatile. Bitcoin is dangerous because of philosophy. It questions whether monetary authority must always be centralized. Whether money must always be someone else's debt. Whether trust must always be placed in institutions. Rules instead of rulers. Traditional money is governed by people. Committees meet. Decisions are made. Discretion is exercised. Sometimes wisely, sometimes not, always subject to human judgment. Bitcoin is governed by rules. Those rules are simple and merciless. Fixed supply, 21 million. Never more. Predictable issuance. New Bitcoin enters the system at a known, declining rate until the last one is mined, around the year 2140. No discretionary intervention. No committee can vote to print more. No crisis justifies exception. This is both Bitcoin's strength and its greatest weakness. Because rules do not care about suffering. Rules do not respond to recessions. Rules do not rescue anyone. Rules do not stabilize employment or fund infrastructure. Bitcoin offers fairness, not compassion. And fairness, it turns out, is a complicated thing. Why Bitcoin feels morally attractive to many people, especially after 2008, especially after watching the system rescue itself while abandoning households, Bitcoin feels honest. Not stable. Not efficient. Not practical for daily coffee purchases. But honest. Everyone plays by the same rules. No one receives money first. No bailouts. No privilege. No backroom deals. The same rules apply to a hedge fund in Manhattan and a farmer in Kenya. This moral symmetry matters deeply in societies exhausted by asymmetry. Bitcoin does not promise prosperity. It promises neutrality. And neutrality, after decades of feeling like the game is rigged, is incredibly powerful. Why Bitcoin cannot replace banks? Now I need to be honest with you. Modern economies require credit. Businesses need financing to grow. Households need mortgages to buy homes. Students need loans to afford education. Governments need fiscal tools to manage recessions. A world without credit would be poorer, not freer. Bitcoin cannot replace banking. And it was never designed to. It cannot manage macroeconomic cycles. It cannot respond to pandemics. It cannot stabilize employment during a downturn. It cannot fund infrastructure or social programs. Bitcoin is not a system of economic management. It is a system of monetary discipline. Think of it as a constitutional amendment for money, not a replacement for the entire government. Bitcoin is a mirror, not a solution. This is the part most people miss. Bitcoin does not fix inequality. Inequality existed before Bitcoin and will exist after. Bitcoin does not fix capitalism. Capitalism is a system of production and exchange. Bitcoin is just a monetary asset. Bitcoin does not fix politics. Politics is about collective choice. Bitcoin removes choice intentionally. What Bitcoin does is expose. It reveals how dependent modern systems are on discretion, on expansion, on the belief that tomorrow will always grow. Bitcoin asks uncomfortable questions. What if scarcity mattered again? What if limits returned? What if money remembered discipline? What if we couldn't print our way out of problems? These questions are uncomfortable precisely because they challenge assumptions we stopped questioning decades ago. Power reacts, not because of fear. States did not react to Bitcoin because it threatened their currencies. Dollars were never going to be replaced by Bitcoin for daily transactions. States reacted because Bitcoin questioned legitimacy. If people can store value outside the system, permanently, without permission, then monetary authority becomes optional. Not irrelevant. Optional. And optional authority is fragile authority. This is why governments tolerate Bitcoin as an asset but resist it as money. You can buy it. You can sell it. You can speculate on it. But try using it to pay your taxes. Try using it to settle a debt in court. Try using it as your primary savings account while ignoring the central bank. The distinction is deliberate. Bitcoin and the idea of sovereignty. Monetary sovereignty is not really about control. It is about coordination. Taxes, spending, employment, stability, all require a common unit of account. Everyone needs to agree on what a dollar is, what a euro is, what a pound is. Bitcoin refuses to be that unit. It stands outside sovereignty. It does not govern societies. It governs itself. This makes it powerful and limited. It can be a hedge. It can be a store of value. It can be an escape hatch. But it cannot run an economy. Why Bitcoin persists despite everything? Bitcoin has been declared dead hundreds of times. Banned in multiple countries. Ridiculed by every establishment figure you can name. Crashed by 80% more than once. And it keeps coming back. Not because it is efficient. Not because it is fast. Not because it is user-friendly. But because its idea cannot be unthought. Once humanity sees money without permission, money that cannot be printed, cannot be diluted, cannot be controlled by any committee or any government, it cannot forget it. Even if Bitcoin failed tomorrow, if the network somehow died, if the price went to zero, the concept survives. The door has been opened. The deeper transformation. Bitcoin is not replacing money. It is transforming how people think about money. It separates money from the state, money from debt, money from discretion. Whether this separation is good or dangerous remains unresolved. Honest people disagree. Smart people disagree. And they should, because the stakes are enormous. But one thing is certain. It is irreversible. No government can uninvent the idea of decentralized money. No regulation can make people forget that alternatives exist. No amount of ridicule can erase the question Bitcoin asked. Transition to Part 5. In the final episode, we look forward. Not to prices. Not to technology. Not to predictions about whether Bitcoin will reach some number. But to the future of money itself. A world where central banks go digital. Private money competes globally. Trust becomes the scarcest resource of all. And the most important question returns, the one we started with in episode 01. Can money survive without belief? If this episode made you uncomfortable, good. If it made you question things you thought you understood, even better. If it made you realize that the money in your pocket is someone else's debt, and that Bitcoin offers something genuinely different, then we're doing what this series was meant to do. Not to tell you what to think, but to give you the tools to think for yourself. Here's what I need from you. First, hit that like button. It tells the algorithms that deep questions still matter. That understanding the system is more important than just participating in it. Second, subscribe if you haven't already. Episode 05 is the finale. We're bringing it all together: central bank digital currencies, the future of trust, and the one question that will define the next decade of your financial life. You absolutely do not want to miss this. And third, and this is the one I genuinely value most, leave a comment. Tell me, did Bitcoin make sense to you before this episode? Does it make sense now? And most importantly, do you think money should be controlled? Or should it be governed by rules? I read every single one. I want to know what you're thinking, what you're questioning, what you want me to go deeper on in future series. This isn't a lecture, it's a conversation, and your voice is part of it. So like, subscribe, comment, and I'll see you in episode 05, the finale. Until then, keep questioning the things everyone else takes for granted.